Right here, USD, daily resistance, 3 failed attempts, beautiful breakout on the 4th try. Most traders go long, stop loss just below the breakout candle. 20 pips of risk. Watch what happens next. That move you just saw isn't bad luck. It isn't random. It's the most predictable pattern in trading. And once you can see it, you'll see it on every chart you open. In the next 12 minutes, I'm going to show you exactly where the next stop hunt will happen on your chart, and why your stops are the fuel that moves price. Let's start with the reframe. Most traders think their job is to predict where price goes, to be right, to call the top, the bottom, the breakout, the reversal. That mindset is why 90% of retail accounts blow up. Your job isn't to predict. Your job is to see where stop losses are stacked and to position yourself so you profit when those stops get hit. Because the market doesn't move randomly. It moves toward liquidity. And liquidity on every chart means one thing: resting orders, stop losses. Big money, banks, hedge funds, the algorithms running on prop desks, they can't fill $100 million position at the current price. There aren't enough sellers there. They need volume, so they engineer it. They push price into a pocket where retail stops are stacked, trigger every one of them, fill their own position into that flood of orders, and then move price the other direction. That's a liquidity sweep, sometimes called a stop hunt. It's the same thing. In this video, I'll show you the 4 exact places it happens: equal highs and lows, trend lines, session ranges, round numbers. Once you can see all 4, you stop being the liquidity. You start trading with the people hunting it. Section 1, equal highs and lows. The most obvious version and exactly why it works. Watch this. 2 swing highs sitting at almost the same price. Maybe 3, maybe 4. To you, it looks like resistance. Solid resistance. Price tried twice and failed twice. So you draw your line at the top and you wait for a short setup. Here's the problem. Every trader watching this chart sees the same thing. Every textbook tells them the same thing. Resistance is rejected. Sell at the top. Stop above the equal high. So every retail stop sits in one tiny zone, right above that line. Thousands of them, all triggered if price ticks 1 pip higher. That's not resistance. That's a magnet. Now watch. Price doesn't reject. It explodes up, sweeps the cluster, hits every stop, and then drops. Hard. Often in a single candle. That's not a failure to break out. That's a successful liquidity sweep. The pattern is so consistent that institutional desks have a name for it: buy-side liquidity above swing highs, sell-side liquidity below swing lows. They don't trade resistance. They trade the liquidity above resistance. Reframe. When you see 2 equal highs, you don't see resistance anymore. You see a target. A target the market is going to hit, sweep, and reverse from. The sweep is your entry signal, not the failure. How to actually trade it. 3 steps. Step 1. Mark the equal highs on your chart, just a horizontal line across them. Step 2. Wait. Don't pre-position. Don't sell at the level. Watch for price to push above the line. Step 3. Look for the reversal candle, a strong bearish engulfing, a pin bar with a long upper wick. Wick into the liquidity, body closed back below the line. That's your entry. Stop above the sweep wick. Target the next major swing low, 2 to 1, 3 to 1. Some of these run 4 or 5 times your risk. Same pattern works for equal lows in reverse. Sweep below, reversal up, long entry. That's the cleanest version of liquidity. But the next type is even more deceptive. It's hidden in the trend line you've been drawing for years. That's next. Section 2, Trendline liquidity. Look at this chart. Classic uptrend. Higher highs, higher lows, 3 or 4 clean touches on the trend line. To you, this looks like a textbook trend trade. Buy each pullback. Stop just below the line. And here's where it gets predictable. Every trader watching draws the same line. Every algorithm scanning the chart finds the same touches. Every YouTube guru tells beginners to trade the bounce. So where do their stops go? Just below the trend line. In a cluster. In a huge cluster. Watch. Price punches through, hits every single stop, and then it reverses right back into the trend, sometimes within an hour, sometimes within the same candle. That's a trendline liquidity sweep. Smart money knows where retail draws lines. They engineer the break specifically to flush stops and refill long positions at a better price. This is why most beginners give up on trend trading. They get stopped out at the worst possible price, watch the trend continue without them, and conclude the strategy doesn't work. The strategy is fine. Their stop placement is feeding the engine. Reframe time. You're not asking, is the trend line broken? Trend lines aren't broken. Trend lines are tested. They're tested specifically by sweeping the liquidity beneath them. You're asking, did the sweep complete and reverse? The playbook. Step 1. Find a clean trend line with 3 or more touches. Step 2. Don't buy the next bounce. Wait. Most beginners enter the 3rd or 4th bounce, which is right before the sweep. Skip it. Step 3. Watch for the violation candle, a candle that pierces below the line. Step 4. The entry isn't the break. The entry is the close back above the trend line with a strong bullish candle. Stop below the sweep low. Target the trend continuation, the previous high or beyond. In downtrends, it's the same pattern flipped. Sweep above the descending trend line, then continuation down. Equal levels. Trend lines. Both visible, both predictable. But the next type of sweep happens at the same time almost every day, and most retail traders don't even know it exists. That's next. Section 3. Session liquidity. Forex trades in 3 sessions: Asia, London, New York. Each one has its own personality. Asia is quiet, range-bound, low volume. Most of the major institutional players in London and New York are asleep. So Asia builds a range, a high, a low, a few hours of chop between them. Then London opens. Volume comes in, volatility spikes, and here's where the magic happens. Watch this. Roughly 80% of the time, London either sweeps Asia's high or Asia's low, not both. One side, and then it reverses and trends the other direction for the rest of the session. That's the New York reversal model, sometimes called the Asia sweep setup. It's so consistent that prop desks build entire trading systems around just this one pattern. Why does it work? Because by the time London opens, every retail trader who was up overnight has placed orders around the Asia range. Breakout buys above the high, breakout sells below the low, stops on the opposite side. London volume comes in, sweeps the side with the most stops, and the smart money on the other side gets filled. How to trade it. Step 1. Mark Asia's range. The high and the low from roughly midnight to 7 a.m. London time. Pick a window and stay consistent. Step 2. Wait for London to open. Sit on your hands. Don't predict which side gets swept. Step 3. Watch the first 30 to 90 minutes of London. Which side gets swept first? Step 4. The reversal entry. The sweep candle has to close back inside the Asia range. That's your confirmation. Enter on the close of that candle. Stop above the sweep wick. Target the opposite side of the range minimum. With strong momentum, it runs through. This setup alone, if traded patiently, with no FOMO entries on the wrong side, can produce 4 to 6 high-probability trades per week. Almost daily opportunity if you only need one good trade. The London into New York transition does the same thing. London builds the range, New York opens and sweeps it. Trades reverse into the afternoon. Same model, different session. 3 traps so far, equal levels, trend lines, sessions. But there's one more type of liquidity that catches even experienced traders. And it's not technical, it's psychological. That's next. Section 4, round number liquidity. This is the simplest trap on this list and the most overlooked. Round numbers, big numbers, 1.10, 2,000, 5,000, USD at 1.10000, gold at $2,000, Bitcoin at 50,000. These prices have nothing to do with technical analysis. There's no support there, no resistance, no volume profile, just a round number that humans find satisfying. But here's the thing, The entire retail trading world watches round numbers. Limit orders cluster at exact round prices. Stops cluster at the next round level. Algorithms specifically scan for liquidity at round numbers because they know the orders will be there. That makes them magnets. Even when no one is openly talking about the level, the volume sitting at the level pulls price toward it. Watch. USD trades up toward 1.10. Stalls. Buyers think it's resistance. They sell short. Place stops just above. Price ticks 1 pip above the round number. Algorithms see the buy-side liquidity. They push price up through the cluster. Stops trigger. Big money fills sells into the panic buy stops. The pair reverses down, sometimes 100 pips in a single session. The reframe. Round numbers aren't levels. They're targets. Price is drawn toward them, sweeps the liquidity above or below, and then reacts. Playbook. Step 1. Mark major round numbers near current price. Whole figures, half whole figures. The bigger and rounder the number, the stronger the magnet. Step 2. When price approaches the round number, do not enter at the level. Don't sell resistance, don't buy support. Step 3. Wait for the sweep. Look for the rejection candle just past the round number. Strong reversal candle with the wick poking into the round level. Enter on the close. Stop above the wick. Target the next major level. One more thing. The bigger the round number, the longer the sweep takes to play out. A sweep through 1.10 can form over a full session. Be patient. The reaction is worth it. 4 places liquidity stacks. 4 places stops get hunted. 4 reversals you can predict on every chart. 1. Equal highs and lows. 2 swing points at the same price. The cluster above or below is the target. 2. Trendline liquidity. Stops cluster below the trendline. The break is engineered to hit them. 3. Session sweeps. Asia builds the range. London or New York sweeps one side, reverses for the session trend. 4. Round numbers. Magnets. The bigger the figure, the bigger the sweep. Here's what changes when you internalize this. You stop selling at resistance. You stop buying at support. You stop trading trendline bounces. You stop fading round numbers. Instead, you wait for the sweep, the wick into liquidity, the reversal candle. That's your entry. Better risk reward. Higher probability, lower stress. Your job isn't to predict where price is going. Your job is to spot where the trap traders are and trade against them. If you got value from this video, leave me a comment with the cleanest sweep you've spotted on your charts this week. I read everyone. See you in the next video.